Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Rod Turner, CEO of Manhattan Street Capital, as my guest. Rod, welcome to the show.
Thank you for having me, Michael. I'm glad to be here.
All right, give us an idea of you, Manhattan Street Capital, and then I have a series of questions I'd like to get to with you.
So I have the good fortune to have started my career as an engineer on a nuclear power station in England and moved on into selling and marketing mini computers in England and then in the US when I emigrated to the US at the age of 23. And since then, then I moved into startup companies, and I've had further good fortune in that I've played a key role in building 6.5 successful startup companies. The 0.5 is this one because we're not liquid yet, but we're doing well with Manhattan Street Capital. So that's a snapshot of me. I've done a venture capital fund with a good friend of mine during the 90s, and I did, as a part of those startups that we built, one of them was Ashton Tate, the publisher of DBase 2, which we built into the leading microcomputer database in its day. And we went public in 1983, which definitely ages me, but that's okay because I'm aged. I'm not a young whippersnapper. And Symantec was my second IPO, where we went public in 1986, actually, also a long time ago. And I ran the largest mergers. It's more than just running them, but I drove the largest mergers and combinations at Symantec when we started buying companies, especially the Norton Utility, Peter Norton Computing Company. I led that merger, which was tremendously successful and really fun, and became Symantec during that time. So I was with Symantec almost 10 years. And then more recently, I've been mentoring, guiding companies, and started a fintech company in 2011, which didn't succeed. It was called Start.ac, donation crowdfunding for businesses and charities. Start.ac, a company, a charity. And, it was a lovely model, but it failed anyway because I made a bunch of mistakes there. Learned from it, and then paid close attention to the Jobs Act. And when the SEC announced Regulation A+, I decided to launch this company, Manhattan Street Capital. We were the first platform dedicated to Reg A+ to go live in May of 2015, 2 months before Reg A+ went live itself. And that's been our initial focus now. We've broadened it. Essentially, Reg A+ has tremendous potential, which we might get into later. And we've broadened our focus to include regulated initial coin offerings or securities token offerings since August of last year. So we've been gradually moving into that space in order to help companies make token offerings and coin offerings that comply with the SEC regulations properly, whether they're offshore companies or US based. So we're leading that. We're leaders in understanding how to do that properly in a way that makes it relatively straightforward to do one of these offerings in the way that the entrepreneurs have come to expect within reason.
Now, you had to have some inspiration that caused you to want to launch Manhattan Street Capital. Let's get the backstory on that.
Yeah, so this might sound weird. I mean, so I have two motivations, right? One is I can't help myself. I'm 61. I can't help myself, but I'm always driven. I've always got to be doing something significant, the most significant thing that I can find, and making it successful. That is who I am. So I'm pretty much useless at vacations. I got to do something, unless there's stuff to do there, in which case I'll have a blast and it's cool. So that's part of me, is I can't be not doing something. So I'm looking, when I'm not doing something, I'm looking for the next thing to do where I can have a positive impact of the most possible scale. And frankly, the other thing, which will sound like bullshit, but is totally true, is I think I got this probably from my mother, who was incredibly incredible. She was just an incredible role model. And you know the way you pick up things from your parents. I have a need to help less fortunate people. It's not like it's a desire to be generous. That's nonsense. I have an actual need. And when I'm not doing that, I am feeling discomfort. So when I do that, it's actually selfish because I feel better afterwards, which again might sound really weird, but it is true. So the point is this, that when we get Manhattan Street Capital to scale, then I intend to do things that help less fortunate people, as well as, of course, what we're already doing, which is helping smart, successful entrepreneurs accelerate the success of their companies and do good with that too, wherever possible. So I'm looking forward to when we have deep enough pockets that we're not just going to give money to charities and things, although that's nice and we've already done a little bit of that. It's going to be more of enabling companies whose focus is to be profitable and accomplish good things for human beings around the planet. So funding those kinds of companies and helping them succeed is something that we are going to do. We'll be generous with when we have some scale and spare capital to do so. And the other thing is that when you're leading a sizable business that is successful, you can do great things for your people. If the nation's healthcare system is abysmal, which it is in my view, we can do well by our people, and we will, and our investors and our customers, our investors in our own company and the investors in our client companies and for our client companies, which all gets very obvious.
Is that what makes you unique in your industry sector with what you're doing, or is there something else you want to bring out before we move on?
Yeah, thank you. So in terms of what we do, getting away from why we're doing it, or why I'm doing it, we are unique in online platforms to raise money in a number of ways. We're very selective. We've said no to far, far more companies than we've said yes to, because especially in the early days with Reg A+, many companies that were not going to succeed in Reg A+ wanted to do it anyway. And I was politely pointing out this and other methods that would work versus doing what would not work. Our success depends on having a high win rate for the companies and for the investors, where they're celebrating afterwards that they did a Manhattan Street Capital deal. We will, in my view, strategically, we win long term by having incredible word of mouth. That comes from engagement, being involved, and being selective. So we have a high win rate, and we are on the team. We're not spectating. We do fewer transactions, but we are in to win with our companies, doing everything we're allowed to do in this regulated space to help our companies succeed in the best possible manner and have the investors celebrate, right? Just because you can raise the money doesn't mean it's going to be a long-term success or that the investors are fairly treated. So we're looking at all of that. And we also look strategically at the entire journey, whether it's regulated ICOs or Regulation A+ itself, through to IPOs and the post-market liquidity issues and poor performance of many of the Reg A+ IPOs. We look across the whole scope of the industry because we depend on the success of the industry. And if I can find solutions that other people aren't looking for, then so be it, because we depend on that success. So we've got to find the solutions. We look at it across the whole game. I think we're probably unique in that. There are other things we do along with that, but I won't get into too much detail.
No, that's a good answer for me, and I find that as a real differentiator between the other investment banking types that I've spoken to, and it's really our differentiator too. We have the same goals. From just as I was hearing you, I was like, well, this is my story too. But let me twist this a little bit. What advice do you have for young entrepreneurs getting started now, from to enhance their career and enhance their company's path?
That's a fantastic question, and it's a long subject that I really enjoy helping entrepreneurs with. So one big thing is do it, because so many people sit on the sidelines and wish they had, and evaluate and microanalyze and study the subject. Do it is one thing, pretty obvious. The other one is for someone who's 18, 16, 20, 22, that has no relevant experience, but the desire to become a successful entrepreneur, depending who they are, in many cases, they should join a relatively young company that is already showing signs of success in any capacity. In which case their skills, their merit will rise to the occasion. And they're there to learn the ropes. They're doing it for a few years to get wise and smart on all the nuances of this stuff. Then they may be much more prepared to do it properly. Of course, true entrepreneurs who sort of got it genetically, of which there are not that many probably, they don't need that. But, Bill Gates didn't need that, right? Steve Jobs didn't need that, although they learned from their early activities. But those are the two things I would say. And beyond that, don't do the conventional, do the unconventional. So by that, I mean obvious things where whenever I've made big shifts in my career, because I switched from being an electrical engineer to selling computers in the computer industry to startups to, well, more startups. That wasn't quite such a big switch, to venture capital, you name it. In the earlier years where I was getting employed by somebody versus doing it myself, which has been the case for many, many years now. In the early days, if you're one of the thousands of applicants responding to an advertised job, the likelihood of you showing up, no matter how wonderful you are, is very, very slim. So don't wait for that stuff. Find the companies that are great, doing what you want to do, that offer the right dynamics, and go to the CEO's office and make an appointment if you can, or get referred to the right person, because it's so unusual for someone to do that. You stand out right away, and you'll end up talking to somebody where it's not one of thousands. You're the only person in months that's come in with a CEO referral. Even if they're only a manager or a director, you stand out right away. And I've done that. It's obvious, right? I mean, you just have to just go to the sources, which takes effort to figure out which of the players, et cetera, et cetera. And if that's confusing, hope I'm not taking too long. If that's confusing as to what to do, go out and spend 6 months interviewing with companies that kind of make sense incrementally, and then figuring out an adjustment, and then an adjustment, and then an adjustment to where you know what you want. And it's not a mystery. Then target those companies and get successful. That is how I found Ashton Tate. I was 24, 25. My first startup company of any significance, and I was their 12th employee, but they were already successful. That was not a risky move, but I had talked to every company that was a mover and shaker in microcomputer software, because I had, after 6 months, figured out microcomputer software was the place to be in 1982, right?
Got it.
When it wasn't immediately apparent at that time.
Let me move forward here. You're very familiar with the ICO market. Mm-hmm. Give us an idea of how to make a regulated ICO succeed.
So, thank you. So the first issue, of course, the thing which is flummoxing many entrepreneurs that want to do their ICO is how do they make it fit within the SEC regulations. And so it's both very complex, but at the end of the day, once you understand all the moving parts, it's not as bad as it seems. So we're at the leading edge of solving those problems in ways that are useful. So talking to us or talking to other companies that are active in this space will help. And securities attorneys, although you can't go out sort of randomly and employ securities attorneys. But let me stick to the big picture for a moment. The things which the mistakes which I see being made, which kind of in a way defines what you should do. I see companies that have merit in their business that want to leverage an ICO opportunity to raise money and for other wonderful things, but they'll do a sort of what I call a strap-on token, where it's like, this is the business, this is the token. They're not mutually additive. It isn't really doing much, and that isn't going to work. You've got to have a fundamental understanding of why the blockchain is useful and do something value added with it. That makes sense for the team and makes sense if you have an existing business for your existing business. Otherwise, you're doing another startup, which is unrelated and probably not going to do a very good job, falling between stones. So that's one big mistake. Another is naivete and optimism, excessive optimism about the regulations, like my token is a utility, even though I'm raising millions and millions of dollars from people, or I intend to, from investors. If people are buying it as an investment, the SEC is going to say, my God, in almost every case, there's only very, very few, microscopic number of exceptions to that. So that naivete is largely gone. People are getting the message mostly these days, but that's a huge mistake to avoid. Another thing I see is companies thinking that they're they're in the US, but they think they can transplant themselves offshore and that it'll be easy to do that legitimately. Absolutely not the case. If you're in the US, it's going to be, you look like a duck, you walk like a duck, you squawk like a duck, you're a duck. So, dig into the regulations thoroughly, and then people will usually realize they don't have as much flexibility as they thought, and they're better off using the SEC regulations and living within them. Then,
let me ask you this. We don't have a whole lot more time, so I want to get down to...
Oh, I'm sorry.
That's all right.
Yeah.
No problem. It's not your last, it's just your first.
Yes, cool.
So, Reg A and IPO trends. I want to know more about what you see happening in that sector.
Yes. So, to hit a couple of important metrics about Reg A Plus, it's been growing slowly from the beginning because it's totally different than what went before.
Right.
And the awareness level has been very low in building, and the trust level has been very low in building too. So what's happening now, though, is it's growing quite rapidly. So we're seeing 60 to 80% growth year on year between 2017 and 2018. And I'm actually quoting some numbers here that we've done the research on because it's very difficult and time consuming to find out what the successes have been, how much money was raised. So I can tell you from that research that through June of this year, approximately $1.6 billion has been raised in Reg A Plus, and that has been a fast curve where more of it's weighted to 2018 and the latter end of 2017. 2016 was pretty quiet. So that's impressive. It now exceeds all of the private placement industry US-wide, which is $1 billion a year. So it's still a tiny number relative to where I think Reg A Plus will get. But fast growth. We're experiencing rapid growth. That's one key metric. And on the IPO front, about a year ago, 14 months ago, was when the first Reg A Plus IPO went live. And since then, subsequently, during the rest of 2017, there were a series of them, about 12. And most of them have suffered in the aftermarket, and that's the significant challenge we face right now. But, one has to recognize that this is phase one of Reg A Plus IPOs, where it's been tough. The companies haven't always been the best suited, and the biggest single issue has been that they haven't been able to use the green shoe, which is used in a full commit S1 IPO and could be used in a full commit Reg A Plus IPO, but they don't do full commits yet because it's new and they're small raises. Anyway, long story short, if you take away this protection, which post-listing in a relatively illiquid, newly listed public company provides protection from naked shorting, which brokers are allowed to do with impunity. So you're really vulnerable. That is the reason the green shoe was invented. The company called Green Shoe was the first to use it. They're now StrideRight. I think it was 1960 was the first use of the green shoe. The Green Shoe Company was their name then, right? Mm-hmm. Anyway, so that's a huge issue. We've come up with a solution for that, and we're working with our IPO candidates that are going down through our funnel and our journey, which Reg A Plus is a journey. It's not an overnight thing, to help them prepare thoroughly in many, many ways, not just that way, to provide them with a far better likelihood of post-listing success, because we have to demonstrate that as an industry before we're going to open up the larger volumes that are appropriate and needed across the board.
Tell me that, in your opinion, we've got the Reg A Plus is a new, very exciting way for capital formation, but we also have ICOs, and I'd like to get your opinion of where you see those two trends. Do you think they're ever going to cross paths where one is going to overtake the other in regards to popularity for funding of companies?
So to me, it's pretty clear that over time, it's all going to blend together. Right now, it's completely different, but we'll see, we've seen token offerings with no rights whatsoever, but you own the token and you hope it goes up in price. That's the vast majority of them today. The trend is towards asset-backed tokens with dividends, tokens with ownership. They're getting more and more like shares. So this is not an overnight thing. It's going to happen faster in the US because of the regulations and people. It's easier to get it through the SEC when it's it's got share rights, but you're calling it a token. So some people are doing that, but that doesn't necessarily work with the people who are actively investing in ICOs. That's another important factor. But I see this all blending together over time. We have one company that did a successful ICO in 2017 that is working with us to do a IPO over the next, maybe 9 months or a year from now. And that would, on the face of it, that has tremendous potential because it's a real company. It's already really active in the token space and with a dynamic model going forward. So an IPO for them selling shares makes a lot of sense, right? That's a legitimate thing, and they want the credibility that comes with that. Separate issue, most ICO companies are getting tremendous liquidity advantages that you don't get until you do an IPO if you're a traditional share transaction. Did that address your question?
It does. It just brought up one other one. And this might be kind of naive, but do you see a time in the future when we're going to be trading convertible, trading tokens in and converting them to shares or vice versa? So,
yes, okay. Absolutely. To me, all tradable, the majority of assets that are, many of them not terribly liquid right now, like micro slices of that big building over there, more and more of them will be liquid and traded through token ownership and similar. We'll see an awful lot of innovation. I'm already seeing it. I have the great pleasure of companies approach us all the time that have fantastic plans. I mean, the level of innovation in the blockchain is exciting. It's so impressive. And I'm seeing all these models, and obviously not talking about one to the next company. Obviously, that's the way it has to be. But it's really inspiring to see lots of impressive stuff being done there. So things will be better for the investor, better for the owner of the asset, better liquidity. None of this is instant. It's going to take time, right? But it's going to be amazing in my view what that brings to the table.
Rod, it's been a great interview. I want to thank you for being a guest. I look forward to more conversations with you about innovations and the companies that come to you.
Thank you very much. Great to be here. Sorry, I was trying to pack more in than there was time for, but this is obviously I enjoy this stuff. Thanks.
Like I said, it's our first interview where there's plenty of time to talk about other topics and other companies that come over the board.
All right, look forward to that. Cheers. Thank you.
All right, thanks for watching CEO Money. I'm Michael Yorba, your host. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel. We'll be back with more great content for you real soon.